Very good afternoon, learners. Welcome to today's session. This is another session in the area of financial management. I am Dr. Neha Seth and I am working as an associate professor with School of Management Studies, Indira Gandhi National Open University. And the topic of today's discussion will be leverage analysis. So let's start with the meaning of leverage. What do we understand by this term called leverage? Okay, this term is very frequently used in the subject called physics. But what does this word leverage means in finance? So just to understand the meaning of finance first, leverage means how well we are able to utilize our resources. Okay, it is about utilizing our resources in an efficient manner so as to achieve the desired results. Okay, so it is about efficiency. It is about how well we are in the position to use the available resources. At the same time, leverage also means the relationship between two variables. Okay, and the variables should be interrelated. These variables should be related to each other. So one may be dependent variable and another may be independent variable. For example, if I want to relate it to finance, one variable may be sales, which is an independent variable, and another variable may be profit, okay, which may be dependent variable. So our profit is dependent upon sales, and the relation between these two is known as leverage. To be specific, it is called operating leverage. We will get to know that what do we understand by this term operating leverage as we proceed in this session today. Leverage also reflects the responsiveness of one variable over another variable. So basically how our profit is reflecting, how our profit is changing, giving response to the sales. Okay, this may be defined by this term called leverage. So leverage can be represented with the help of this formula wherein the change in dependent variable will be divided by change in independent variable. Okay, this is what we understand by the simple term called leverage. Now we have to relate this term with finance because we are studying this subject, financial management, and we need to understand that how leverage is impacting our financial decisions. So in finance, leverage is majorly divided into two parts, and then there may be another classification or another part which we may call a combined leverage. So first one we have is operating leverage. Okay, how we can calculate operating leverage and what is it? Let us understand with this table. So we start with sales because we are talking about finance. We may start with the sales. What we need to deduct from sales? We need to deduct variable cost. Okay, and once we will deduct variable costs from sales, we will get contribution, and after subtracting fixed costs from the contribution, we will get profit. And in terms of financial management, we call it earnings before interest and tax, that is EBIT. So this journey from sales to profit can be defined as our operating leverage. So if we want to fit this thing in our formula, what we may have, so our change in profit or change in EBIT, when we are dividing it by our change in sales, this may be defined as our operating leverage. On the other hand, when we are using this profit, okay, and from this profit we are deducting interest. Interest is also known as fixed charge because this is the fixed amount that we need to pay if we are using debt in our capital structure. And after deducting interest, we will get earnings before tax. Right, and out of this we have to deduct tax, and after deducting tax amount we will get profit after tax, or we may also call it earnings after tax. Okay, after dividing these earnings after tax by number of equity shares, we will get EPS, that is earning per share, right? And when we divide this earning per share, or I can say the change in earning per share, by change in EBIT, okay, so this part may be defined as the financial leverage, right? So when we are studying the change in profit, which is happening because of change in sales, that means we are talking about operating leverage. So in this case, the financial cost is playing major role. But in another case, when we have EBIT and we are trying to study the impact of EBIT on our EPS, then this is known as financial leverage, right? And in this case, interest, or I can say the fixed charge, it plays the major role. And when we are combining these two types of leverage, operating leverage and financial leverage, then we may have combined leverage. Okay, so let us understand this one by one in detail, right? So first one we have is operating leverage. What is operating leverage? Operating leverage is something that affects the firm's operating profit, that is EBIT. This is what we just now understood with the help of the table. Okay, so degree of operating leverage. So one term is operating leverage, another is degree of operating leverage. It may be defined as the percentage change in EBIT, and it is reflective of percentage change in sales. So it is exactly the same thing that I just told you when I was talking about this table. So when we have seen the formula of leverage, it talks about percentage change in dependent variable and upon percentage change in independent variable. So in this case, in our case of operating leverage, what we have as dependent variable, that is EBIT, and this has to be divided by our independent variable, which is sales in our case. So this is how we can calculate the operating leverage. So this may be represented with the help of this formula, where percentage change in EBIT has to be divided by percentage change in sales. The same thing can also be presented in this way, where change in EBIT has to be divided by EBIT in numerator, change in sales to be divided by sales in denominator, and this is how we can calculate degree of operating leverage. Now let us understand this with the help of numbers. Okay, so let us take this case where at present our sales is 1000 units. So at present we are selling 1000 unit and we are expected to sell 1400 units. Okay, and the sale is happening at the rate of rupees 10 per unit. Since we are selling 1000 units and 1 unit's cost is rupees 10, so our sales will be 10,000 units. And in this case, we are selling 1400 units. The amount of sales or sales price per unit is 14 rupees. So our amount of sales is 14,000. Out of which we have to deduct variable cost. Again, variable cost is also per unit cost. So 7 multiplied by 1000 in case of present sales, we'll get this value 7000. And when we are multiplying this amount with 1400, we get 9800. We need to deduct the variable cost from sales and we will get this amount called contribution, right? 3000 in case 1 in case of present sales and 4200 in case of expected sales. Now what we have to do next, we have to deduct fixed costs from this. Okay, fixed costs will remain fixed, whatever amount you are, whatever units you are selling. So it is 1000 in case 1 and again 1000 in case 2 as well. We have to deduct fixed costs from this, and the amount that we will get is our EBIT. Okay, this is 2000 in case 1 and 3200 in case 2. So what is change in EBIT? It is of 1200 rupees. Okay, and what is change in sales? It is of 4000 rupees, right? Now we need to use this change in sales and change in EBIT to calculate our operating leverage. We just need to fit these values in our formula and we will get our answer. So our change in our operating leverage formula was change in EBIT divided by EBIT, and this whole amount has to be divided by change in sales divided by sales. Okay, so change in EBIT was rupees 1200, EBIT originally was 2000, change in sales was rupees 4000 and original sales was 10,000. Using this we can calculate our operating leverage, which is 1.5 in this case. Degree of operating leverage may also be calculated by using this formula, where we can divide contribution by EBIT to get the degree of operating leverage. Now let us see how we can calculate this using exactly the same example, exactly the same numbers. Okay, it is the same table that we just now discussed. So in present, again, the amount of sales is 10,000 and contribution was 3,000 in this case. In this case, our contribution is 4,200. Second thing that we need is 2,000 EBIT in case of present sales and 3,200 in case of expected sales. So degree of operating leverage, what another formula we just now learned, it is contribution, which has to be divided by EBIT. So contribution in first case is 3,000 divided by EBIT, that is 2,000. And see, the value is same. In this case also, our degree of operating leverage is 1.5. Similarly, in case of expected sales, we have to divide 4200, which is our contribution, by 3200, which is our EBIT. Okay, and we will get the value of degree of operating leverage in case of expected sales, which is 1.31, right? So this is how we can calculate the degree of operating leverage, either if we want to using the first formula or the second formula. So whatever formula we are comfortable in, we can use this formula. And by learning that how this operating leverage is calculated with the help of number, we can now extract the proper definition of degree of operating leverage. And according to this calculation, according to what we have learned so far, we can say that whenever the percentage change in EBIT, which is resulting from the given change in sales, and this amount is greater than the percentage change in sales, operating leverage will exist. Okay, and this relationship is known as degree of operating leverage. In simpler words, as long as degree of operating leverage is greater than 1, that means operating leverage exists, right? And when there is a situation of break-even point, so there will be no profit, no loss. In this case, degree of operating leverage cannot be defined, right? So from this, we can extract few points that we need to remember while dealing with operating leverage. That operating leverage is change in EBIT, which is resulting from 1% change in sales. So whenever there is 1% change in sale, how our EBIT is reacting to that. When we are trying to study this relationship, we are talking about operating leverage. And it arises as a result of fixed costs. So whenever there is change in fixed costs, whenever there is a significant difference in fixed costs with time or with the change in number of units, there will, in that case, OL will arise. That means operating leverage will arise. But if there is no fixed cost at all, you will not see any operating leverage, because in that case, there won't be much difference between change percentage of sales and change in percentage of EBIT. And the higher the fixed cost, the greater will be your operating leverage, because operating leverage is affected by fixed cost. So higher your fixed cost, higher will be your operating leverage, and larger would be the magnifying effect of the change in sales. Okay, so the higher operating leverage we are dealing with, there will be more fluctuations in the change in sales, which is happening because of change in EBIT, which is happening because of change in sales, right? Then there is a term called positive operating leverage. Positive operating leverage means the situation when the firm is operating at the level higher than break-even level. So whenever the firm is operating over and above break-even level, they are dealing with operating positive operating leverage. Whenever the firm is dealing lower or maintaining or not able to meet break-even level, in that case, they are dealing in negative operating leverage. And the firm should avoid operating in high operating leverage, okay, because in that case, they are impacted a lot because of this fixed cost. Okay, so firm should avoid operating in high operating leverage, because higher operating leverage is very, very risky, and they should try to maintain degree of operating leverage sufficiently higher than break-even level, but not very high, okay, as compared to break-even level. So this was about operating leverage. Similarly, we can move ahead and learn about financial leverage. So operating leverage deals in operations when we are starting with sales and we are reaching to profit. Financial leverage starts with the profit, okay, which was the end point of operating leverage. And now financial leverage is impacted by fixed charge, that is interest. Okay, so I can say here that financial leverage or the use of fixed charge on source of funds. For example, we are using debt or maybe preference capital along with equity shares, okay, in our capital structure. And this may be defined, the use of fixed charge may be defined as our financial leverage. Financial leverage may also be known as gearing or trading on equity, right? The financial leverage employed by a company is intended to earn more return on fixed charge funds than their cost, right? And financial leverage, just like operating leverage. In operating leverage, what we did, we are dividing change in dependent variable by change in independent variable. So in that case, our dependent variable was EBIT and independent variable was sales. So in case of financial leverage, our dependent variable will be EPS, earning per share. Okay, and now what would be our independent variable in this case? Our independent variable will be EBIT, because we are starting from EBIT now. So formula will remain same, just we need to change is the variables that we are using. So for the formula of degree of financial leverage, how we can use our variables, it will be like percentage change in EPS, which has to be divided by percentage change in EBIT. Okay, in this case our sales and EBIT is replaced by EPS and EBIT. This may also be represented like this. It is absolutely similar to what we learned about operating leverage with a change in variables. So percentage or change in EPS divided by EPS, whole amount divided by change in EBIT divided by EBIT. Okay, let us understand this with the help of numbers. So this is the case when we don't have any fixed charge. That means we are not using debt in our company. Our present sales and our expected sales again will remain absolutely same, as we are using the same example that we have used so far. So our present sales will be 1000 and our expected sales will be again 1400 units, right? Our EBIT was 2000 and our in present sales situation, in expected sales situation, our EBIT is 3200. But there is no interest in this case, because we are considering a case wherein we are not using any type of debt, right? And after that, after deducting interest, what we usually get, we get earnings before tax. Okay, but since the earning before tax and EBIT is same, so there is no need to write it separately. After this, I have to deduct tax, which is 50%, and after deducting tax, we get this amount E80, that is earnings after tax. What I need to do? I need to divide this earnings after tax by number of shares, and when I am going to divide earnings after tax with number of shares, what I will get? I will get my EPS, right? So in this case, my EPS is rupees 2 in case of present sales. In case of expected sales, my EPS is rupees 3.20, because in both the cases I am dividing my earnings after tax with number of shares. Okay, so this is the case when we don't have any debt, we don't have any fixed charge. So what is happening when the sales is increasing? Sales, how much sales is increasing? Sales is increasing from 1000 to 1400 units. Our EBIT is increasing from 2000 to 3200 units. So what is the change in EBIT? That is 1200. And 1200 is 60% of our existing sales. 1200 divided by 2000, it is 60% of our existing sales. And what is the percentage change in EPS in this case? Our EPS is 2000 in case of present sales and 3.2 in case of expected sales. Again, how much changes? Changes 1.2 rupees. So 1.2 divided by 2, which is equal to 60%. So our change in EPS is absolutely equal to change in sales. So change in EBIT. So if our EBIT is changing by 60%, our EPS is also changing by 60%. And this is the case, this is the situation when we don't have any fixed charge, when we don't have any interest in this case. So percentage change in EBIT will be absolutely equal to percentage change in EPS in this case. Now let us see what will be the situation when there will be fixed charge. Taking absolutely the same example, again our EBIT is 2000 in case of 1000 units, and our expected sales, which is 1400 units, in this case our EBIT is 3200. Now we are using rupees 3000 at debt, and which is raised at the rate of 10%. Okay, so change in EBIT is 1200 units. What is the percentage change? 1200 divided by 2000, that is 60%. Okay, now we are deducting interest, which is 10% of 300. Okay, 3000, which is 300 rupees. Now our profit before tax is 1700 and 2000 respectively. We are deducting 50% tax, and now we have earnings after tax. Number of shares will remain same, that is 300 rupees. Now 900 divided by 300 in present case. So our EPS is 3 rupees, and in this case 1500 divided by 300 to calculate EPS, our EPS will be 5 rupees. That how much change is there in case of EPS? That is rupees 2. And if you want to calculate percentage, it will be 2 divided by 3, that is 66.67% approximately. So now you can see that how EPS is reacting to existing of debt in our capital structure. So earlier there was no debt. So percentage change of EBIT is absolutely equal to percentage change in EPS. But now in this case, when our EBIT is changing at the rate of 60%, our EPS is changing 66.67%. So you can see that how the presence of debt, okay, presence of fixed charge is impacting our financial decisions. Okay, so this is the importance of financial leverage. Financial leverage, just like in case of operating leverage, we have used another formula, that is contribution may be divided by EPIT. Similarly, in case of financial leverage also, we may use one more formula, that is EBIT divided by EPS, right? So we can also see that how we can calculate the same thing using this new formula. Again, we are using the same table, same numbers to understand how this another formula is applicable. Exactly same values. Okay, EBIT 2000, 3200, interest is 200. We have deducted here, we get 1800 and 3000 as profit before tax. Okay, degree of operating leverage may be calculated by when EBIT is divided by EPS in this case. So what we have to do, EBIT divided by EBT in this case. Okay, so here 2000 will be divided by 1800. So 2000 will be divided by 1800, we get 1.10. Okay, similarly in this case 3200 will be divided by 2000 to calculate degree of financial leverage in this case. Okay, so this is another formula, but the impact, the calculations and everything will remain same as we did for operating leverage using two different formulas. Okay, so in this case also we just need to remember a few points. The financial leverage is percentage change in EPS, which is result of percentage change in EBIT, and it is emerging as a result of fixed financial cost. Our fixed financial cost here in this case is fixed charge. So if there is no fixed cost, no fixed charge, there will be no financial leverage at all. The higher the fixed cost, the greater would be our financial leverage, and the larger would be the effect of change in EBIT, that is because of change in EPS. Positive leverage means the situation when the firm is operating at a level of EBIT which is higher than financial break-even point. So if the firm is operating above financial break-even point, that means firm is operating in positive financial leverage. But when the firm is operating below this break-even level of finance, or I can say it is dealing in the lower level of financial break-even point, then they are dealing with negative financial leverage. Okay, so this is another thing. One, we discussed about operating leverage. Second, we discussed about financial leverage. And the third thing is combination of both, that is combined leverage. So when we are combining these two things, operating and financial leverage, we can have the combined effect of these two leverages together by using this concept of combined leverage. Okay, so operating leverage affects the firm's operating profit, whereas financial leverage affects the profit after tax or earning per share. So these were the two things we just now discussed. And degree of operating leverage and financial leverage, when these two are combined together to see the effect of total leverage on EPS, which is associated by given change in sales. So in case of operating leverage, we started with sales and we ended up with EBIT. In case of financial leverage, we started with EBIT and we ended with EPS. Okay, so when we are seeing the combined effect starting from sale to EPS, so this is the case when we are talking about combined leverage. That means we are dealing with combined leverage. So combined leverage can be calculated by combining these two formulas of operating leverage and financial leverage. So combined leverage can be calculated by, this was the formula of our operating leverage, change in EBIT divided by change in sales. This was the formula of our financial leverage, that is change in EPS divided by change in EBIT. And EBIT will be cancelled out with EBIT, and what we left with, change in percentage change in EPS divided by percentage change in sales, and this is our combined leverage, right? So this combined leverage may have a ultimate effect on our financial decisions, or we may combine these two type of leverages which are dealing at different level, according to which we may reach to certain conclusion. This may be reflected with the help of this table. When we have high operating leverage and financial leverage is also high, so this situation is considered very risky, because in this case we are dealing in high interest outflow and it is not matching with our earnings. There may be another situation in where our operating leverage is high but our financial leverage is low. Okay, sales are still unsatisfactory in this situation, to fixed costs to be absorbed, and long-term borrowings are not a strain on earnings in this situation. Then there may be third case when our operating leverage is low but our financial leverage is very high. Okay, so this is considered to be the ideal situation for profit maximization. Okay, and then there is fourth situation when our operating leverage is also low and financial leverage is also low. So in this case the management need to be little cautious. They need to handle this situation properly so that they will not fall in any kind of trouble. So this is how we understood the impact of leverage on our financial decisions, and this is all about leverage analysis. Okay, that is all from my side today. So see you very soon in the next session. Till then, happy learning.
Myself Gina Jameson and I am coming from Kerala. I have done Masters in Travel and Tourism Management in IGNOU. I have gained gold medalist category.